Imagine watching your investment portfolio plummet by 20% in a single day, feeling anxious and making impulsive decisions to sell, only to see the market rebound shortly after, resulting in significant losses. Welcome to the world of finance, where making smart investment decisions can be the key to building wealth. However, many investors often find themselves making emotional decisions that can hurt their financial future. For instance, imagine buying a stock based on a hot tip from a friend, only to watch its value plummet shortly after. Or, picture this, selling a stock in a panic during a market. When it comes to investing, emotions can play a significant role in decision-making, often leading to choices that hurt our wealth. Many investors make the mistake of letting fear, greed, or anxiety drive their investment decisions. For instance, during a market downturn, fear might prompt an investor to sell their stocks, only to miss out on the potential long-term gains when the market recovers. On the other hand, greed can lead investors to take on excessive risk, investing in assets that are overly volatile or unproven, in hopes of making a quick profit. A classic example is the dot-com bubble, where one of the primary reasons investors make emotional decisions that hurt their wealth is due to fear and greed. When the market is plummeting, fear sets in, and investors tend to sell their assets in a panic, often at the worst possible time. Conversely, when the market is soaring, greed takes over, and investors may overinvest, expecting the trend to continue indefinitely. For instance, during the 2008 financial crisis, many investors sold their stocks at a significant loss, only to see the market recover in the subsequent years. Similarly, in the cryptocurrency boom of 2017, confirmation bias is another emotional pitfall that can hurt investors. When investors have a strong opinion about a particular stock or investment, they tend to seek out information that confirms their bias, rather than considering alternative perspectives. This can lead to a narrow and distorted view of the market, causing investors to make poorly informed decisions. By actively seeking out diverse perspectives and challenging their own biases, investors can make more informed and balanced decisions. Another critical aspect to consider is the role of fear in investment decisions. When the market experiences a downturn, many investors panic and sell their stocks, fearing further losses. However, this knee-jerk reaction can lead to significant losses and missed opportunities. For instance, during the 2020 market crash, many investors sold their shares, only to see the market rebound shortly after. If they had held on to their investments, they would have avoided substantial losses. Similarly, when the market is booming, investors often get caught up in the excitement. One of the primary reasons investors make emotional decisions that hurt their wealth is due to a lack of understanding of their own emotional biases. For instance, the fear of missing out, or FOMO, can lead investors to make impulsive decisions, such as investing in a stock that has recently surged in value without conducting proper research. Conversely, the fear of loss can cause investors to hold on to a declining stock, hoping it will rebound, rather than cutting their losses and moving on. Additionally, emotional decisions can also be driven by recent events, such as a market downturn, which can lead to a decrease in risk. Now that you understand the dangers of emotional decision-making in investing, it's time to take control of your financial future. Consider the story of an investor who sold their stocks during the 2020 pandemic, only to miss out on the subsequent market rebound. Don't let fear or greed dictate your investment choices. Take a step back, assess your goals, and create a diversified portfolio that aligns with your risk tolerance. By doing so, you'll be better equipped to make informed, rational decisions that can help you achieve long-term financial success. In conclusion, emotional decision-making can have a significant impact on your investments. By recognizing the emotional pitfalls and developing a rational investment strategy, you can protect your wealth and achieve your long-term financial goals. Remember, investing is a marathon, not a sprint. Stay informed, stay disciplined, and stay focused on your objectives.